Welcome to the Big Mike Fun Podcast, where you learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in. Because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fun Podcast. I'm the Big Mike
Zlatnik, and today it is my pleasure and a privilege to welcome my really good friend, Marck de Lautour. Hi, Mark.
G'day, Mike. Thanks for having me.
Thank you so much for coming on the podcast. How's Kansas City? Getting cold, right?
Yeah, we've had a fall. I mean, we're kind of a four-season city, but fall seems to be an abbreviated one sometimes. But no, it's really nice. It's getting a little brisk, but no, we're still getting the temperature climbing up to in the 60s and low 70s. So it's a nice time of year.
Well, enjoy the fall. The fall has all the colors, but it is getting colder, and I guess I'm in New York, same thing. You just got to dress in layers. You never know when it's going to be a warm day or it's going to be 40 degrees. So, all right. So, anything new in the world of Mark? Any comments on kids, cats, pets, family, anything? What's going on? Just tell us a little bit about your family, and we'll move straight into the business right after.
Yeah, sure. We are a family. We have a junior and a freshman in high school. So I've got two high schoolers now, Mike, which is crazy to say because they still seem just like my young little kids. But one of them is playing a lot of competitive baseball. So heading next week down to Vegas on a travel tournament. And my daughter loves volleyball. We just wrapped up high school volleyball. She played a ton of games. I think they had 35 games, and I think they only lost 3 games. So they had a really good season.
You're bringing up champions. So hopefully your son that's playing baseball, one of his days will hear as a major leaguer.
That would be fun. That would be his dream for sure.
Well, enjoy the kids. It's a lot of fun to go to sporting events with them, and they train hard, and it's a lot of satisfaction as a parent to see your kids do well in school and also do well in competitive sports. I know the drill. My girls ice skate, and we certainly love to travel to competitions because we know how hard they train, and it's always a lot of pride for the parent to see your kids compete and do well.
Yeah, I think at this age, at a very young age, it's not so much important. They don't have jobs, right? So their job is not to work. Their job is to work hard, is what I tell them. So if they have a good work ethic, I think we're doing a good job as parents. And my son is extremely driven. I mean, he's waking up at 5:30 in the morning to go work out for an hour and a half of lifting before he goes to school at 7:15. So yeah, he's got his head on straight for sure.
Wow, that's amazing. You brought up a couple of good boys, so congratulations. All right, so let's jump into real estate. So how is real estate in Kansas City? And before we'll cover a couple of topics. One is rising interest rates, how it's impacting Kansas City. Also, is this a good time to buy real estate? A number of folks are a little bit concerned with rising interest rates. Is this the right opportunity, the right time? Are the deals good enough, or people should sit and wait for a better deal, or the deals that they get today are still great deals? So any quick thoughts on, let's start with, is this a good time to buy real estate still?
Yeah, I mean, I'm a big believer in a buy and hold mentality. It would not be a good time at all, Mike, if you're speculating, if you're trying to time the market or flip a house. Got to be very, very cautious. The retail market has certainly dried up here in Kansas City. As you know, we do probably 70% kind of full turnkey selling rent. So for your audience out there, turnkey real estate is the idea that we would buy a house, rehab it, get it rented out, and then sell that asset that's a rental ready product with a tenant in place to an investor who's just looking to build a portfolio. That's a turnkey rental. And so we do about 70% of that. We also have about 30% where we flip, because obviously we're out there trying to find deals. And so there's always, opportunities and deals on the flip side where we might buy something for $250,000. We put $50,000 into it, try and sell it for $360,000, $380,000, something like that after all expenses. Try and make a 10-15% margin on those houses. Those margins are getting compressed. It wasn't a huge part of what we did. We cleared out of most of the inventory pre-crash, just obviously with seeing it coming. But I'll be honest, I mean, there's been houses we've lost money on, and that's a very strange thing for us, Mike. I mean, we pride ourselves in hitting just singles all day long. We don't hit many home runs. We're not trying to make $100,000 on a transaction or anything like that, but just a lot of base hits and singles. But even on the singles, sometimes when you've only got a 10% margin and on one particular area, there's just no buyers anymore. With interest rates climbing up to 7%, we have certainly felt the impact. And I think our market has seen about a 10, sometimes a 15% drop in the price of our assets. And so on the flip side, with retail buyers, that's caused some consternation and trying to get rid of product in a meaningful way. But back to your question of whether it's a good time to buy, that's offering us opportunities in the market to buy deeper. And for our investor base, we're obviously pricing our turnkey product cheaper than we would have perhaps 6-7 months ago. So there are discounts in the market for those that are wanting to buy and hold long term. It's a great time to buy.
Yeah, Mark, I greatly appreciate the color, and it makes sense as interest rates rise and the buyers dry out. You as the buyer of pre-rehab properties, you get a better deal, and that's the whole idea. Is you get a better deal, you put the construction in place, you execute, and then you sell to the turnkey buyer at a lower price, and that makes total sense.
Yeah, lower price and higher cap rate. So our cap rate has remained the same, Mike. So I mean, essentially what we've done is as interest has increased, and actually a little bit, we actually had to do an insurance adjustment as well because our insurance rates went up when we turned the corner. So we've had a little bit of a bump in insurance, and obviously a bump in the interest rate that we were projecting. We were projecting at a 5.5, and now it's at a 6.5. So the interest rate has gone up, and that obviously means that if we want to continue to sell at a 7 cap, we reduce price. And so our investors are getting a better deal than they would have just a short while ago.
Right. So that makes a lot of sense. I mean, you're trying to basically package, I guess, to investors for a cash and cash return. So I assume that cash and cash return, you're trying to keep it the same level. And as rates rise, you have to lower the price to make the numbers work. Exactly.
We've got two numbers that we really focus on. There's the cap rate and the cash on cash return. The cash on cash return, we're still trying to prove into double digits, but we're consistent with the cap rate at 7%.
Yeah, it makes sense. So, but the market has corrected, and that's an important point. The market has corrected, as you said. If I understood it correctly, 10 to 15%. That's what has happened in the last. Since March? Is that the correction that you've seen?
No, Mike, I think it's even more compressed than that. I think it really only happened. I mean, gosh, June, July was still hot months for us. I think after July, it's really been the last 3 months that there's just been a screaming of brakes thrown on the market. I mean, clearly, it seems to me that the Fed is trying to do this. The government is trying to slow down at all costs. It has to battle inflation. So they are literally raising interest rates at a rapid pace to try and just curb all kinds of activity. And obviously in Kansas City, like most markets, we have a season, and the hottest season of the market is July, August, September. So that was obviously spurred on with people trying to buy. But once September hit, it almost ground to a halt on the retail sales. And so, yeah, inventory is now creeping up. Demand is down. And so those that have to sell, the only way they can do it is dump price, which is why those speculators that have to sell at all costs, the only way they can sell is by dumping. We're very patient. We're not on our flip stuff. We're in a good position. So we're just patiently holding. We've reduced price for sure, but we're not just dumping. We feel like on a newly remodeled product, our stuff will sell before someone else's. So we're being very cautious on making sure that we're hitting that perfect amount of a price reduction at the same time, not giving the house away.
Yeah, appreciate the caller. Most of the, I guess, Midwest and Northeast has massive season. And if you're in these in the weather, when people come out when the weather is nice, then the demand for purchases is obviously high. And the summer, the rates were substantially lower. The rates have moved since early summer or middle of the summer up substantially, and as the result, yeah, we're dealing with demand destruction. And I'm reading the book, and you've heard of this book, but it's a great book called The Lords of Easy Money. And it's a phenomenal book, just kind of explaining the inner workings of the Fed. And I'm an economist at heart. So to me, reading the book, I discover a lot of insight of how they have discussed issues, how they think about it, But at the end of the day, you're absolutely right. Jerome Powell, with a well-respected Fed chair, he is on a mission to fight inflation, and he's made multiple statements that they can't fail the inflation fight. So I don't see them stopping anytime soon. And everything you said is consistent with many other markets where the prices have softened simply because affordability. People just can't afford higher mortgage rates. It's debt to income ratio. So if you're buying a home to live in, and whatever your income is, these rapid and very so fast and furious interest rate increases have hurt DTI, debt to income ratio. You just can't meet the requirements. So you can't afford to pay what you paid before. The math is pretty simple.
And I think we're also, Mike, going to get in a position, and this is not a now, but this is a year or 2 years from now, where those people that bought, say, 2 or 3 years ago that have locked in a 2.75% rate, and now everyone's get the itch, you know the deal. Everyone kind of, the white picket fence and the house and 2 kids. Suddenly they have 4 kids. 5 years later, they want to move into a bigger house. How can they move from let's call it a $200,000 mortgage at 2.75 to a $500,000 mortgage at 7 or 8%? I mean, they're just not going to move. So I think not only is it an affordability crisis, it's also going to stop people from moving, which then stops title, U-Haul trucks, handymen, house inspectors, appraisers, mortgage company. I mean, the ramifications of just slowing down housing is vast and wide.
Yeah, they call it demand destruction. That's all they can do. The government printed too much money, caused a lot of inflation. Obviously, COVID caused supply chain problems, but at the end of the day, they only have one tool, and what they control is the money supply and the interest rates. And
yeah,
the goal is to get inflation under control, and that is causing exactly what you're saying. And then, by the way, the point you brought up about the interest rates being 2.75 or 3% or 3.5% on a previous property, and folks cannot move because they can't afford a newer house with a much higher interest rate. That is absolutely a problem in residential market. In the commercial market, the problem may manifest itself a little differently. Folks who bought in with bridge loans and those loans mature from 3, 4, 5 years ago, now they need to refinance. Same problem happens. The only saving grace in this environment is inflation causes rent inflation. So rents go up. As rents go up, incomes go up, and that's supposed to be the offsetting factor. But for the owner occupied, you're right. If you are a family of 2 and you had 2 more kids and you're trying to buy a bigger house, good luck with that. It's a massive problem from that perspective.
Yeah, I think the other thing that we've noted here in the Kansas City marketplace is new construction grinding to a halt. For single family homes, at least. The sales of new construction single family homes have just ground to a halt. The only thing that's still selling is, multifamily new construction. There's still apartment complexes and we're building fourplexes and duplexes that are still, in demand. So we feel confident in our positioning on those. But I have a friend that he came and talked to me the other day, and he has 21 lots in a new subdivision that he had kind of gone all in on, and he has not been able to sell the first 6 houses that have come out of the ground. And it was just terrible timing. Again, should have seen it coming, but at the same time, he's in a world of hurt. I just don't know how he exits, because the only exit for that, they're so expensive that you can't rent them really. I mean, I don't think, and you can't have a whole subdivision of short-term rentals. I mean, I know a lot of people. In fact, one of my strategies, there's 2 properties in Kansas City that, we are not in a good position on. And if I had to sell them retail, I would probably lose, maybe $30,000 or $40,000. But as a short-term rental, they'll turn around in cash flow. So I've got an exit strategy on 2 higher-end homes in good areas that now have just not been able to sell. But you can't have a whole subdivision of short-term rentals. So very low exit strategy. And I think those are the kind of opportunities. I think, people are saying, what are the opportunities? I think there's going to be a lot of people that, suddenly became a new home builder because they thought that was a cool thing to do. And there'll be those opportunities of people going under and banks having to take back these kind of single family communities again. And REO will be popping up, in the next 12 months.
Yeah, that's an interesting observation that the Fed is going to accomplish what they're actually trying to accomplish. they will put the economy in a severe recession. And I've spoken about this multiple times, but really inflation can't come down until unemployment comes up. It's the Phillips curve. It symbolizes the relationship between unemployment and inflation. And the Fed can't stop until inflation comes down. Inflation doesn't come down until the unemployment comes up. In order for the unemployment to come up, you need to have a lot of layoffs because there's a very substantial shortage of labor. Until and unless we start seeing substantial corporate layoffs, and the layoffs will be driven by the weakening economic activity. I mean, that's your classic recession. So from my perspective, at least the way I see it, is we need to start seeing substantial layoffs announced. Then inflation will have a chance of curbing. And the Fed is just not taking the foot off the pedal until they're going to cause enough damage. Again, demand destruction, damage, all the related activities where the transactional volume falls. No activity of that, a lot of people will not have the jobs because there's nothing to support. And the same concept could apply to big banks. A lot of transactional volume will fall, and a lot of banking employees should be looking for, fortunately, pink notices. So, well, whatever they call pink slips, or go look for a better job. But
Yeah,
that's coming, unfortunately.
Yeah, there's a local friend of mine owns a mortgage brokerage here, and he's already laid off. I mean, the refi business, as you know, is non-existent now. There's no such thing. So, there are layoffs happening already. And when I've heard one protagonist state that gas prices will hit $8 a gallon sooner rather than later, and I mean, that's just going to trickle down. I mean, it has to have an impact. There's no way that goods get to our front door without, some gasoline being spent. So, it's going to have a massive effect.
Yeah, just a quick comment on the energy side. So you have a great point that there's a concern that the energy prices could climb into the cold winter, and the concern is real. It's certainly going to hurt Europe a lot more than us. At the same time, what they're doing is the demand destruction will weaken the demand for oil too. So as much as there's fear of oil shooting through the roof, I'll also comment that as the economy slows down, the demand for oil will slow down. So the oil price, it's energy, it goes into everything. So inflation can't really come down either until the oil price starts retreating, because oil price is into everything, from transportation to manufacturing to heating and so on. So we do need to see oil soften as a part of the story to get the inflation under control. Anyway, so what are again, all that aside, this gloomy and doomy picture, what are the good news, right? Let's shift to a little bit of the opportunities. So why should people still buy turnkeys today? What's the bright side? Can they buy something better in 6 months? This is one of the questions that folks struggle with. If I sit on cash, yeah, inflation is destroying it. On the other hand, if I buy this house for $150,000, maybe I can buy that house for $130,000 in 6 months. If I can get that kind of a discount, I can live with the fact that the money is going to be idle for 6 months. Why should they buy today?
Yeah, great question. And we're getting that question a lot with all of our investors. And the deep discounts, that people are expecting, I think there's a disconnect between thinking that they're going to get a $20,000 or $30,000 discount on a price. Inflation is holding asset values actually very high. And so we're encouraging all of our investors that it is a good time to buy. Rental real estate does not ebb and flow the same way the retail real estate does. So when I'm talking about movements in the market of Kansas City going up and down, I'm certainly referencing the retail market. As far as turnkeys, yes, we're reflecting, a price reduction. But I mean, you're talking, maybe $5,000 to reflect, where the interest rate has moved. And remember, a couple of things. So you are getting a small discount to buy now. The second thing is cap rates are the same. You're still buying with that same return, even though cash on cash returns are slightly more compressed. Interest rates are temporary, Mike. I mean, I was talking to one home buyer, a really big home buyer in the city, a home builder in the city yesterday. And he's a single family home guy. And he was commenting how he said the only good thing, Mark, is that interest rates are so high right now that it's easy for them to make the move come March, April, or May. He feels like they're trying to slam on the brakes so hard that we just lurch into that devastation, lack of demand, that you were talking about, and the destruction. But and then clearly with winter coming and the normal slow season anyway, it's really going to grind to a halt. He feels that there will be some kind of correction come, April, May, June next year, where they'll be able to reduce it a full percentage point or 75 basis points to try and spur the market on. Again, he was just commenting that it's just gone up so quickly that clearly he felt like before they only had they could only put their foot on the brake. They couldn't put their foot on the accelerator if they wanted to. There was no impact. It was just running out of control like downhill. They had to pump the brakes hard enough to where they can actually have an impact if they want to tap their foot on the accelerator once in a while. So that was an interesting point that this big home builder was making. I like the thought also, Mike, that there is no time like now. A house is a basket of commodities, as Bruce Norris likes to say. And as inflation rises and as rental rates rise, so does everything, the value inside the home. So, the home price will go up because as inflation rises and gas rises and all our prices rise, the faucet that we put in for $150 can no longer be put in for $150. With labor and materials increasing, it is literally raising the value with this basket of commodities that you're sitting on. So that is all one of our points. The last point I would make, Mike, and I would love your thoughts on this, is you have to do something with your cash. Like sitting idle cash is, burying it under mattress, sticking it in a bank, which is equivalent to the same thing, it is not a good investment strategy. Yes, you have to make wise investments, but you have to make investments. And so those that are looking for, again, if that's speculating, I would say just absolutely pause, don't go out and speculate. But if you have a strategy, you're working with an investment firm that can help you invest that capital on a wise basis, either through into some, commercial investments or residential investments, turnkey homes, would always encourage, investors to go and spend money building an asset column, because as inflation goes, so goes assets, the value of those assets on the back end.
Yeah, thank you, Mark, for sharing that. I certainly agree with you that the house is a basket of commodities. So the cost-driven inflation of these commodities has inflated the value of the house, and it'll continue to be the case. So that makes total sense. As far as the theory that the cash sitting in the bank is eroding in value, I agree with you. Generally, there's only two reasons to keep the cash in the bank. One is as a dry powder. So if you're thinking it's going to be more great opportunities in the future, and you want to have the dry powder, and then two is some kind of safety. You have to have some percentage of your portfolio in cash. Beyond that, obviously, idle cash is the yield on the portfolio, and it's eroding value with the high inflation. So no argument there. But I will provide an interesting comment. So I agree with you that the interest rates are too high now for the U.S. economy to function well. So in general, the U.S. economy is heavily leveraged at every level, and high interest rates, at least at the level where they're now, make it very difficult for the U.S. economy to function. So you're right, the Fed pushed the accelerator pedal hard and fast, and that push was so substantial that we're now beginning to feel the pain, and the pain is beginning to be very significant. I will say this: I don't have a crystal ball, or I used to have one. It broke. Can find another one for sale. You've heard that story before. The Fed loosening again in the spring would be absolutely great news. I mean, I would certainly welcome this. A lot of people would welcome this, as the imposed pain is already substantial. Nonetheless, I think it'll be a little bit later in the year. This is my position, for the point that you have a natural spring when people will come to buy anyway. It's just because it's a seasonal cycle for Midwest, Northeast, and other regions. But the interest rates, for them to start reversing them, to start dropping the rates, it's back to the point I mentioned earlier. They need to see inflation figures substantially come down.
Yep.
And we're not seeing that yet. So I don't know what it'll take. I certainly feel and think that energy prices need to at least be sustainable, not escalate higher. If the energy goes up, that's a lot of pressure on inflation to continue to stay high. But what's really important is the fact that actions today take time to kick through the system. So they've made a lot of changes, a lot of rate hikes, and it takes 6 to 12 months for them to kick in. So it is possible by the spring we'll see year-over-year inflation figures at that point substantially better than they are now, and that's the hope. But that's an optimistic hope. I was a little bit in that camp, but I have to say that now I feel that it's probably going to happen, but somewhat later next year. And I wish it was a little bit earlier, but we'll have to watch and see. But at the end of the day, U.S. national debt, the debt of corporate debt, the entire students' debt, the housing debt, everything else revolves around interest rates. And the economy functions on interest rates. We just can't function on these rates. What's really crazy is this. I remember when the rates were at this level, 6.5%, 7 years ago. But this was years ago. Now we've taken so much more debt from previous point that you can't compare that. Yes, the rates used to be in the 6.5%. That was sustainable then. Now we are in a very drastically different position. We moved from the rates being about half this to where they are now within less than a year. And then that's the biggest problem, is that the speed of change and the volume of change is of unprecedented proportion. Nobody knows really what's happening. As much as Fed is thinking they know what they're doing, I have to say that they're steering a gigantic ship with just two levers, right? The primary lever being interest rate that they set, and two, the quantitative easing or quantitative tightening. And my concern is they will overdo, and they will overdo massively. And before they know, they'll realize that the ship has passed way beyond the point that they wanted the ship to go to. Unfortunately, we will find out when it happens, and it's not going to be a pretty picture. So it's something like this that we just don't know. We just have to go with the Fed. Don't fight the Fed, flow with the Fed. That you heard that expression. The problem is, even the Fed doesn't really know what they're doing, in my view. At least they have a bunch of very smart people, PhDs in economics and incredibly smart economists. At the same time, they've never done this before. They've never raised interest at this speed and at this velocity and size in the past. So we are kind of entering a period of unknown, no precedent.
Yeah, we'll see. I was a little more bullish on this next 6 months being, because I'm thinking in 6 months they may lower, but again, it remains to be seen. When you're saying 6 to 12 months for that to kick in, that makes sense. So we'll see. There is no crystal ball. I'm hopeful, I guess more so than well, I'm optimistic that they will get some. I just feel the pain, at the pump. I feel the pain from consumers. I feel the pain from people that are buying on the retail side. So I see it and feel it. So I know that if we're feeling that in the Midwest, my goodness, the coast must be getting hammered as well. And I just believe that people are going to have to start cutting back on luxury and any kind of consumer spending that would not be normally done. So then you get Airbnbs and hotels that are going to stop getting people traveling. The airlines just seem to come out with record profits, but I don't know if that's going to be the truth for Q4. We shall see. But I feel that the economy has slowed down very quickly, and I'm hopeful that in the next 6 months, especially with this new rate hike that they're calling for, that we will be able to get back to some sense of normalcy for next year. So again, it's all about setting expectations, Mike. And again, one of the other reasons, that we still can operate is because, we are in the living room. We are buying houses on a daily basis. We're seeing the sellers and educating the sellers as to, why their home is not worth what they think it's worth. Oh, my neighbor sold theirs for 150. Okay. That was in a different universe. That was 7 months ago. It changes on a daily basis now. And so we're walking away from deals we would have bought 7 months ago, and that's okay. Knowing this was coming, positioning yourself to be in a position where you can take advantage of the market rather than be subject to it is important. And I feel that most of our friends have kind of positioned themselves that way.
Yeah, thank you, Mark. Just a couple of further comments on this. So the bid and ask have widened. That's what you just said. That the asking price for the sellers is based on their past view of the world, and it takes time for that pain point to sink in, and for them to actually compromise on what they feel that they should have gotten for this house or a commercial property or multifamily. The same issue applies. So the bid and ask spread has to widen, and the transaction volume has to drop until the time where either the pain is too great or the realization just comes in, I can't sell, I need to sell, and that'll just take a little bit of time. So I think we are in agreement that's gonna continue to trickle through in the upcoming months. And you as the buyer of these houses that does a renovation and then sells them, obviously staying very disciplined, and you can't force somebody to sell. You just have to give them enough time where they'll realize. So that's the environment that we're gonna find ourselves in for a while. The volume will just come down. Just it's very difficult psychologically to agree your house is worth less. The only reason you're gonna sell is you lost your job. If you lost your job, then the real pain is now kicking in. But you can't afford the mortgage. If you don't sell, whatever equity you have will dissipate over time. So it's a pain-driven sales decisions. Hopefully not necessarily in the volume we've seen in 2008, where the foreclosure rates were just humongous. Nonetheless, that's what's going to motivate folks to be a little bit more reasonable on a sales side and continue to give buyers better opportunities. And then the other thing that I wanted to say on the rising interest rates, something interesting happens, the substitution effect. I'm sure you're already seeing this. So if people can't afford to buy, what do they have to do? They rent. So the demand for rent increases, generally speaking. You still want to be in that same neighborhood. You still want to be in the same good area, but you just can't afford to pay a mortgage. So you wind up looking for a similar product with a rent. And that's actually good for the owners of the properties. They can increase rents over time. The only pain, the big problem with rapidly rising interest rates, they usually are there because inflation is high, right? So the rents are rising, and that's the good news for real estate investors. The bad news is that when the rates rise faster than you can increase rents, because these moves just happen. They happen quickly, and you were looking for a mortgage yesterday and today, and the rate is up now 50 basis points. So you feel the pain immediately as a buyer, a little bit less cash flow. But the good news is, if inflation continues, you will see higher rents in the future, and that's sort of that's the counterbalancing factor. So it's something to keep in mind, because a lot of buyers get this massive concern. Well, my cash flow has just suffered. Well, that's the truth, right? The price, we're adjusting the price. The prices drop a little bit, but your cash flows drop more because the interest rates push the debt service faster. Just got to be patient to let the inflation kick in over time, those rents to rise over time, and it'll take care. So investing, like you said, speculating for short term now is completely no good. But investing for a multi-year time horizon is still healthy, as long as you have that multi-year time horizon.
Yep, with good property management in place that can handle, a good tenancy, you make sure that you increase rents and minimize, vacancy and maintenance.
Yeah, appreciate your wisdom. All good things must come to an end. That's the expression from Star Trek. I don't know if I'm a trekker. So the last episode of The Next Generation, the godlike being tells it to Jean-Luc Picard, all good things must come to an end. He's about to destroy humanity. But the joke here is I mean this, that only for the reason that good things must come to an end, so does this episode, not the destruction of humanity by
well, I like to think in this rising interest rate economy, Mike, I prefer to think that what goes up must come down.
Yeah, so the rates go up and one day they'll come down. So you just got to be patient enough. And you're right that probably in the let's be realistic here, 2 to 3 year cycle, instead of saying, hey, they're going to start coming down next year, but 2 to 3 year cycle, we'll probably find the rates back down to where they were probably a year ago. And that'll be great news for those folks who held on to real estate, and they'll be in the position to refinance with lower interest rates. That's actually the power When the rates go up, refinance obviously becomes very difficult. But once they start coming down, refinancing becomes a huge viable option, and that stimulates the economy in a massive way.
It does, because then you can also suck out some of the equity that's been built in the last 2 or 3 years as well. So you can harvest the equity, keep your, have your payment go down, lower your interest rate, and pull out some equity.
Yeah, long-term investment and patient. Short-term vision now is going to be difficult. It's going to look a little gloomy, but you have to be optimistic, and you have to be diligent, and you have to do your work and find good deals. And at the end of the day, real estate is still there. It's still better than, in my view, than stock market or many other alternatives.
Yeah, I was just speaking with a client yesterday that was interested in jumping on board and buying some turnkeys, and asked her, hey, what made you pick up the phone and call us? And she said, well, I've been listening to you for a while, but since March, I've lost a third of my 401k. That's a very real thing.
Yeah, unfortunately, folks, that this is the bad part. This is where the Wall Street have got everyone accustomed to invest into what's easy, and what's easy is their products, effectively the stocks and the mutual funds. And most people don't take any action when the market starts correcting, or they do it at the wrong point in the market. So unfortunately, it becomes it's a dropping knife right now. That's the bad part. So folks are saying, well, it's dropped 30%, let's go buy. Certainly a matter of opinion, but it could be a dropping knife. It may not be over. So we'll see what happens.
We'll see. Thanks for your time, Mike.
Thank you, Mark. Appreciate your wisdom. Oh, how would folks get a hold of you? That's really important.
Thank you. Hey, always best to follow on social. You can go to YouTube. We're putting a lot of content through the Mistake-Free Real Estate brand. You can follow me at Marck de Lautour on Instagram, also on Facebook. And so, yeah, please just reach out on social. And I think that's normally the easiest way. I try and put out content. I have a social media manager that loves to, provide and educate, all the things we're talking about today. We're trying to give people insights on a daily basis as how this is impacting, the world that we live in here as real estate turnkey providers. So that would be the best way. And you can always just go to mistakefreerealestate.com.
That's an awesome website, mistakefreerealestate.com. That's great. Thank you for education. Thank you for coming on the podcast. Always great to talk to you. Great to see you.
You too.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to bigmikefund.com or visit Amazon and type Mike's slot name. Keep listening and keep investing Big Mike style. See you on the next episode.